Hello and welcome to a brand new show of India Reboot, the show on which we debate, deliberate, discuss, and ideate that where is India headed? What can be done to fix the current, COVID numbness which has come in the economy, and where are we headed at a time when macro and the global liquidity environment is very favorable? To talk about the banking sector and the allied services connected with the banking sector, I have with me Mr. Amitabh Chaudhry of Axis Bank. Mr. Chaudhry, good morning. Thank you for joining us. It's a very, very dynamic world, Mr. Chaudhry. One side, we are trying to understand the impact of COVID, and on the other side, we are trying to understand that how can one maximize this entire low liquidity environment. So let's start with where your last communication was. In your last official communication to investors and to the markets, you said that, look, there is stress at the retail end of the book, and the stress will continue for some more time, but the recovery will also be equally sharp. Any reason for us to believe that you would like to change your guidance or you would like to stick to it?
Well, good morning, Nikunj. This is not the forum to start changing the guidance, but yes, the positive outcomes that we are seeing play out in collections for the last couple of months are quite obvious, and I think the market is talking about it. We think that if these trends continue, the overall portfolio performance in terms of recovery efforts across the financial sector should be visible. And what we when we did our last earnings call, we said that June was way better than what we saw in May and April, and July is trending better, and August is also trending better than what we saw in June, and slightly better than July also. So in that sense, all the signs are positive. As far as outlook on pickup in capex cycle is concerned, there are reasonable indications that the private capex creation has started, but this is in select segments at this stage. We are certainly seeing a lot more conversations around capex at this time over anything that we have seen in the last couple of years. While the private sector capex is robust in some of the segments, like upstream refineries, steel, cement, chemicals, pharma, renewables, storage systems, the government has come out with a scheme where they're asking for investments in electronics and industrial automation, logistics, etc. Export-oriented industries. The government is also investing a lot in railways, roads, and highways. There are other sectors which are still struggling a little bit, but one is hopeful that if we can contain the issues around COVID, and hopefully it doesn't deteriorate from here, the economy will pick up. The government and RBI have been very supportive, very accommodative. So that is also kind of adding to the hopefully revival of the entire economy. Government's monetization plan, obviously it will take time, but I think the plan is to take whatever money they'll be able to monetize and put it back in the economy. So that should jumpstart the economy further. So signs are all positive. We are quite hopeful. Obviously, there are risks in the horizon, which we all should be aware of, because what COVID-2 taught us was that if it comes suddenly and it comes sharply, and invariably, you find yourself unprepared for it. So in that sense, hopefully we are better prepared. If it comes, hopefully it does not. And so in that sense, the hope is much better than what we had when we kind of had the first quarter call.
If I take the clock back, and I'm going to take the clock, let's say 5 quarters back, when Axis Bank and other large banks, they came out with their numbers post the first wave. They surprised the market because the retail delinquencies, which were expected to be high, were not that high. When the last quarter numbers came out, which was after the second wave, the retail delinquencies were not supposed to go higher after the first wave experience, but they went higher. What changed? I mean, that is the surprise bit for everybody.
So a couple of things happened, Nikunj. One is that let's not forget that there were a lot of retail customers who were supported in the first COVID wave through 2 specific moratoriums and restructuring which was allowed. In the second wave, there was no moratorium. There was some restructuring which has been permitted, but there are certain rules under which that restructuring has been allowed. So a lot of customers who took shelter in the first COVID remain stressed, and kind of the second COVID has pushed them, made them slip. So that is one thing. It's a continuation of the problem. You kick the can a little bit down the road, and now it has come to roost to some extent. Secondly, some people who were able to survive the first and the second COVID could not survive the first COVID wave, could not survive the second COVID wave. Third, in the second COVID wave, the health costs for a lot of people shot up sharply, if not for yourself, not for your family, for the immediate families, friends, relatives, or this fear that if I catch COVID, it could potentially lead to huge health expenses. And please understand, a lot of India is not that that well insured. So in that sense, people also kept some money away or were forced to spend the money, the savings, which they were planning to apply towards repaying their loans. So that is the third thing which kind of obviously did not help matters. Now, a lot of people, because they became a bit careful, also sat on the money and said, let's postpone the EMIs. It's okay, we slip, but if things improve, we'll start repaying. And that's why we are hoping that the recovery of the slippages or even otherwise of the portfolios will be quite sharp. We are seeing signs of it, too early to comment, because all of us are worried about potentially a third COVID wave. But the recovery is also quite solid. And it was evident in the first quarter calls, whatever you might have heard across the financial services industry. So my view is that the circumstances were different. This was here the people suffered more. Everyone got impacted in a way, and in that sense, you saw what you saw. Our hope is that the recovery, because a lot of in our case at least, a lot of these slippages on the retail side were coming from secured assets, and the loan to values against those secured assets were low. We were never worried that the money will not come. It is just a timing issue. That yes, money is not being paid, it goes into slippage, but over a period of time, we'll be able to recover the money either way. Either the customer repays us back, or we are able to sell those assets and recover our money. So in that sense, demand resolution is good. It is moving in the right direction. Recoveries have gained momentum. And also on the corporate books, some large ticket transactions have been completed. So things are looking better. I would say the second half, we are laying the right foundation stones for decent recovery from second half onwards.
The general view is that a lot of big companies are suddenly cash rich. Cement, cash flows are strong. Steel, cash flows are strong. A big company like Tata Steel is repaying debt. A big corporate like Reliance is repaying debt. So while capex has started, do you think a lot of corporates are funding their balance sheets on their internal accruals and they may not tap the bank, which means capex may start, but historical credit growth rate may not come back?
You're absolutely right, Nikunj. I mean, the credit offtake from the system remains moderate. Non-food credit growth as of end of July was 6.2% year on year and has averaged only 6% for this fiscal. So in that sense, the credit offtake is not picking up. As you rightly pointed out, that because of the extraordinary stimulus has led to system liquidity surplus, resulting in firstly lower market borrowing rates. Larger and high rated corporates are sitting on huge piles of cash. They've repaid their borrowings in the market. So the credit growth to the industrial sector has been being driven by mid corporates and some refinancing here and there, which continues in the first quarter of financial year 22. Yes, from an Axis Bank perspective, we believe that there are considerable credit opportunities as the economy starts reviving. As some capex starts, we will get decent opportunities to grow. Our advances growth, as you know, in the first quarter was 12%, even though the credit growth in the first quarter was 6%. SME book grew by almost 18%, despite pivoting to a more conservative approach on lending. So opportunities are there, but yes, as you rightly pointed out, the large corporates, the highly rated corporates have relied on either the bond markets or they're generating so much of cash, and because they're not spending enough on capex, they're sitting on huge piles of cash. And they've used that cash to repay the debt in the system. So the credit growth is quite tepid at this point in time.
So will I be correct when I say that banks historically have been a proxy to corporate growth, but this time it may not translate into the historical trends?
It is possible. The only hope is that as the large corporates start spending on capex, and as that money flows to the mid corporates, the SMEs also, because ultimately when this capex gets done, their entire ecosystem benefits. We will see credit growth come back in some of those sectors. But yes, if they keep relying on the cash which they're generating or some of the other avenues, which is non-bank avenues like equity itself or the corporate bond market or do foreign borrowings, you might not see a direct correlation of that spend coming through in the credit growth in the banking sector, for sure.
So if I have to put the economic environment based on your market commentary and what you've just shared with us, Your ROE of 15 to 15.5%, will that be achievable in FY22 or that could get pushed?
So if you look at our last year's fourth quarter number, we had, or if you take off the one-off items, we had reached the 15% number ROE. Obviously, because of COVID-2, the impact on the retail portfolio, it has got pushed out in this financial year. I don't want to comment on quarter 3 or quarter 4, but we believe that our, if you take off the extraordinary items which are, coming through because of the market situation, the bank is already operating in the zone of 15-16% ROE. But our ambition is to take it to 18%. And getting to 18% from 15-16% is the tough battle, where a number of transformation projects which we are doing across the bank, be it on the technology side, be it on the digital side, be it on looking at each of our businesses and asking ourselves the question, how can we best in class in terms of customer experience here? And how can we best in class in terms of rigor and rhythm we bring to the system? We believe that each of those projects have to contribute for us to get to 18%. It's a long journey. It will take a couple of years for us. But on a standalone basis, without the extraordinary items impacting us, we are supposedly operating in that zone, which we proved in the fourth quarter of last year.
Let me do a relative comparison here. The relative comparison for a shareholder would be ICICI Bank is taking their subsidiaries public. State Bank of India is planning to take their subsidiaries public. You are now the promoter of Max. How are you planning to, in a sense, increase the importance of subsidiaries? Last quarter was a great quarter for you. But how will you differentiate when other banks are really ramping up their subsidiary businesses?
So when I joined the bank in 2018, I had said that one of the important pillars of our strategy would be to further focus on scaling up the subsidiaries so that they gain higher market share in their respective businesses. So as you rightly pointed out, if you analyze the quarter 1 earnings of our subsidiaries, it would be touching nearly 1,000 crores figures, which is an important milestone for us. In that sense, we believe that it is very important for us to scale the subsidiaries further over the next couple of years because we believe the opportunity exists. And then at that stage, again, ask ourselves the question, is there any benefit of listing these subsidiaries? Or we continue to adopt the model as what we have now, which is that we want investors to look at Axis Bank as a group, which has obviously the bank in it and our investments in various subsidiaries. If we have a shareholder in Axis AMC. Today, it is the 7th largest AMC, and it is the largest player in the equity side of the investments that people are making and the money people are putting in mutual funds. Its AUM grew 55% year on year. PAT grew 90% year on year. Axis Capital is continues to maintain its leadership position in ECM league table. If you look at Axis Finance, even though it was a wholesale NBFC, its asset quality is one of the best in the industry, and their foray into retail is also working quite well. If you look at Axis Securities, its profit went up 7 times last year. So in that sense, I think the subsidiaries are tracking well. We want them to focus on scaling up those subsidiaries. The people who work in those subsidiaries are getting stock options in Axis Bank. So I think all the interests of everyone working in so-called Axis Group is aligned to make Axis Bank as the one to kind of benefit from all the hard work which we are doing across Axis Group. A couple of years later, we will see whether we need to reassess the strategy and decide whether we want to list or we continue with what we are doing at this point in time. Right now, we will keep at it. We don't intend to list any subsidiary at this stage.
With any historical conversation of ours, we focused on 2 things: the near-term outlook of interest rates and RBI, and the near-term outlook on NPAs and where NIMs are headed. Let's challenge both of them. I'll not talk about it. I'll talk about the 3 to 5 year disruptive changes which are happening in the banking sector. In the COVID time, we've enjoyed banking experiences sitting at home. There is a new fintech world which is getting created. Korea has got a bank which is a branchless bank. What happens in 3 to 5 years? How will you keep up pace? How will you transform from being a branch-based bank to a bank which is digital stroke financial tech ready?
So banking or any other industry one can think of, be it auto or retail or even media for that matter. Some of the so-called old economy sectors you cannot think of a world in the next 3 to 5 years where technology will not play an important role. Over the past 5 years, the acceleration towards embracing technology with the rapid emergence of fintechs and what has happened with COVID has only hastened this pace. So whoever is unwilling to adopt these new ways of working, what technology is bringing in, will only fall by the wayside. And banking cannot be kept away from it. So from our perspective, we recognize that a couple of years back, we know we have to scale up our investments in technology in a big way. For example, Axis technology spend has gone up by 78% in the last 2 years. We set up a separate digital bank where we have 800 people working. And we believe that we have to disrupt ourselves to ensure that we can compete with what is going to happen in the market and the fintechs which are going to come up. Whoever brings convenience to the customers or in the lives of the customers is not only is going to change the world, is not only going to disrupt it, but is more than welcome, because fintechs and payment companies have done a wonderful job over the years, and that is why we made the acquisition of FreeCharge in 2017. There is no doubt that they will continue to disrupt the market going forward. And if we don't keep pace with them, if we don't partner with them, if we don't embrace what they are doing and their ways of working, we will suffer. So the entire strategy of Axis on the digital front is around changing ourselves, making significantly more investments than what we've done in the past, and also at the same time work in partnership with these fintechs or these new ways of working to ensure that we not only benefit in terms of what they are doing, but in many cases we can provide the pipes or solutions which they never intend to invest in. So a partnership will become even more effective in the marketplace. And you will see Axis partnering with more and more fintechs going forward in the future. So it's just trying to ensure that we have enough things happening at the same time so that we don't miss any opportunity, and at the same time we're disrupting ourselves so that we can compete head on with them and actually give them a tough time in the marketplace and get our fair share.
So what is the next growth frontier? And I'm going to expand on that question, which is that if you look at banks between 2000 and 2020, retail was the growth frontier. Financial inclusion started. Everybody was able to get more fee-based income. That, in a sense, has been the differentiating factor. For next couple of years, what is the next growth frontier for you?
So, Nikunj, at a very simplistic level, if you look at our deposit market share, it's only 4.5%. If you look at advances market share, it's 5.7%. If you look at our RTGS, NEFT market share has been improving, but it is still slightly below 10%. If you look at our share in UPI, it is close to 15%. If you look at our share in credit cards, it's 11%. Why am I quoting these numbers to you? I'm just trying to tell you that if you look at the deposit advances and where we are in terms of the highest market share, we're still a small part of the market. So even for a moment, if I was to assume that the overall market growth will be limited, our opportunity to grow within this market itself is huge. And so as a bank, as we transform ourselves in every business of ours, and there is an opportunity to transform ourselves in every business of ours, there is a huge growth opportunity for the next 5 to 7 years, which is not reliant on the market growing itself. Now, the market itself is growing. The market itself is getting disrupted. And we as a large bank with a strong balance sheet have increased the pace of change, investment in the bank itself. So my confidence in terms of what Axis Bank can be and would be if we execute well is very, very high. Because we have taken all those steps. We are laying the foundation for the future where we can capitalize on business opportunity in almost every segment. You asked me, retail was the way to go. Now, what about the future? My view is retail will continue to grow. We are one of the few banks which can support a corporate across its requirements on lending, borrowing, trade finance, cash management, and everything. So wholesale also we are very strong. SME is a business which Axis has always been strong in. I told you about our UPI market share. On the merchant acquisition side, we are big. Credit card, we are a number 4 player. So we have and I talked to you about subsidies too. So we have an opportunity, the wherewithal, the management, and the talent to be able to go across all these businesses. Why should we leave every opportunity? And we have a very strong balance sheet to be able to support growth across all these businesses. So we are pushing hard. We are pressing, obviously the accelerator, keeping our risk framework intact, keeping conservativeness intact. We believe enough opportunities exist across all our businesses. And that's what you would and should expect of Axis going forward.
Two more follow-up questions. I know you got a board meeting, so I'm taking the liberty of extending this by another 2 more minutes. How do markets value banks? Price to book, asset minus liability. How large is your book? Which is, you'll have to grow your balance sheet size. Do you think the differentiation now will be not growth in balance sheet size, but growth in profitability?
Well, if you look at the price to book as a measure, I think the market has been quite savvy in terms of differentiating across various banks based on the kind of growth they've delivered, the kind of asset quality they have had, and so on and so forth. I think, yes, over the period of last couple of years, very clear that a couple of banks are moving into the kind of same zone. Their balance sheet, their asset quality, their growth strategies, at least in terms of output, tends to look similar. But India is large enough to be able to take a number of banks which will do very, very well. We are the third largest private bank in terms of asset size. We have crossed, 10 lakh crores in terms of our asset size. In terms of market cap, we are slightly behind. And obviously, our view is that we need to just keep doing the right things the right way and keep executing better than what we have done in the past. And finally, if the market recognizes it, market sees that there is more predictability about how we are going about things, it will get reflected in the price. I also mentioned to you earlier that there is a clear move where these bigger banks have benefited at the cost of the smaller institutions. And in a crisis like this, that tends to happen even more or more pronounced than before. So let's see how this plays out. But my view is that the bigger banks have the wherewithal, the balance sheet, the strength, the ability to invest in the future, and they will continue to benefit from an Indian economy, which should start seeing growth all over again. I think the Indian story remains intact. I not only believe Indian story remains intact, there is a huge growth opportunity ahead of this Indian story. And hopefully we'll be able to capitalize on it.
So just to wrap it up with one last follow-up question based on your answer. Mr. Chaudhry, you know this more than anyone else, that when growth comes back, it surprises everybody positively. Barring a risk of a third wave, and I'm keeping my fingers crossed, hand on my heart, that we don't see a third wave, do you see any other risk on the horizon, and do you think if there is no third wave, we are in for a growth surprise?
Ultimately, we are in the risk-taking business. We have to be aware of the risks that exist out there. And in that sense, yes, what the third wave could do, in what form and shape it could come, we have to be very, very cognizant of it and very watchful about that. Keeping that aside, India has not seen capex to the extent given the size of the economy over the last couple of years. So yes, while we are seeing conversations around it, we have to be watchful as to when the economy really starts reviving. So that's the second risk which you'll be aware of. Third, while all of us are talking about technology, digitization, and providing a seamless experience to the customers, we have to be aware of the risks it brings in terms of cybersecurity, in terms of technology not working the way it should work, in terms of the bad experience you end up providing to a customer because your technology does not work. So there is that risk which you to be aware of. Your operating risks increase manifold. So yes, it's not just about investing. We also have to be very fully aware of the risks which you are creating because you're moving towards a more digitized world in the future and everything is connected. So you could get impacted because someone else did not do their job well. Or in some cases, maybe you forgot to, take care of the things that you should have upfront. And that is why the Reserve Bank of India, very rightly so, is coming after the banks and the institutions in general in a very big way to ensure that they have a very robust, strong, scalable technology architecture.
Well, I must say that we've adopted to the digital world, but I still miss the good old days where I would meet you for a coffee and interact across the table for an interview. So I look forward to that interaction very soon. Appreciate your time.
Thank you so much, Nikunj.
Thank you so very much for joining us.
Thank you.